Okay, let's set the record straight. The Federal Reserve does not directly control mortgage interest rates. When you hear that the Fed has raised rates, that is the Fed fund rate. The Fed fund rate is the rate of interest banks pay to borrow money from each other and is usually tied to short-term debt like lines of credit or credit cards. Now, mortgage rates are determined by supply and demand. Here's an example. The majority of home loans made in America are sold to Fannie and Freddie and then sold on Wall Street as a mortgage-backed security. And there are a lot of them, approximately $2 to $3 trillion per year. Now, if investors want to purchase these mortgage-backed securities, then the rate of interest comes down. And if investors don't have an appetite for these MBSs, then the rate of interest goes up. So consumer demand is what really controls mortgage interest rates, not the Fed funding rate. The big indicator right now is the monthly consumer price index. That figure is directly connected to inflation and is the big mover whether or not investors want to buy these MBSs or not. The last 2 months, the consumer price index has been lower than expected, which shows less risk of an inflation and draws investors to want to buy the mortgage-backed securities. And that is why you have seen over the last 2 months, mortgage rates tumble. In fact, we're almost a full point lower than we were in October. So if you've been considering buying a home or refinancing, now's your shot. You can lock into a much lower rate than you could have just a few months ago, which translates to a lower monthly payment and tens of thousands of dollars saved over the life of the loan. The best part? At thehomeloanexpert.com, you can lock in today. And if rates continue to drop, we'll break that lock and relock you to ensure you're getting the lowest rate possible. Got questions on a refinance or buying a home? Let's talk. It all starts now at thehomeloanexpert.com.